Welcome to the After 5 p.m. podcast with Ben McAfee and Sean Russin, where we clock out of mortgages at 5 p.m. and clock into family, finances, and life.
Sean, good to be on the mic with you again. For those who are listening maybe for the first time or looking for a little bit of context on the name of the podcast, Sean and I have worked together for a number of years, currently working for different mortgage companies, but for quite a while there, we worked in the same office and had some pretty critical conversations that were very impactful after 5 p.m. Starting this podcast is kind of getting those conversations started again. We both kind of missed those, and looking forward to sharing some concepts and ideas with each other, having some guests on the show that we might both gain from some of the nuggets that they drop on the podcast along the way. So today's topic, when it comes to mortgages, there's really three main categories that a lender is looking at when analyzing a consumer situation, right? When we're doing a quote-unquote pre-approval, and it's credit, income, and assets. And today we want to kind of talk a little bit more on the credit side of things. What does someone need to do to prepare for before they buy a home or apply for a mortgage, credit-wise? So I just want to ask you more of, I guess, the general question, Sean. If you're meeting with first-time home buyer, maybe doesn't have a whole lot of established credit, what are you coaching them if we're on a phone call and I'm asking, hey, I'm looking to buy a home in the next year, what should I be doing now regarding credit? How would you answer that general question?
Yeah, so if they're a first-time buyer, a lot of times they may not have any credit. So getting established credit or getting some sort of credit built up is one of the first recommendations I would look into or advise them on. And we can kind of go through maybe some credit hacks too if they don't have a credit score. But the big thing is you have to kind of pay to play when it comes to credit. So one of the myths around credit is, well, hey, I don't have any credit at all. I just use cash. I should have a good credit score, right? And that's not how the system works. So there is that pay to play. And usually the first thing, if someone doesn't have credit or if they've been out of the credit game for a long time, is just getting a credit card. So that's going to be the quickest to report. That's how the bureaus look at the credit scores, and we can kind of dive into how the credit scores built up. But the first go-to would be, hey, get a credit card. Let's get that going, and that'll start boosting their score.
Okay. So getting a credit card, why a credit card compared to other loan types? Why not an auto loan? Why not a signature loan? Why credit?
Yeah, so it reports monthly like a lot of the other credits types of credit do, but it's the quickest to report, and from what I've seen in my experience, it'll impact the score sooner and have the biggest impact over like an auto loan or like a mortgage sometimes can take 6 to 12 months to really influence a score. And so that's where hey, if you're looking to buy something sooner, we need the score reported quicker, and we need it to get an actual credit number back from the credit bureaus.
Okay. I had a client just, maybe 30 days ago. The scenario was that there was two individuals. They were current roommates. They wanted to come together and buy a house and buy it together. I pulled credit, and neither one of them had credit scores. And when you pull a report and someone doesn't have a credit score, it comes back not applicable. What advice would you give to them, including the timeline on when they can likely move forward with a mortgage?
Yeah, so there's some cool credit hacks we can look at. So the first credit hack is called an authorized user hack. So with an authorized user, that's where they can reach out to like a family member or a friend, brother, sister, and that family member, whoever it is, they can actually go into their credit account. They don't have to do an application, the buyer does, but that other credit user can go add on an authorized user. What that does is it adds them onto that account, but what also happens is they get all the history of that credit account too. So if that credit card has been open for say 10 years, that authorized user all of a sudden gets all that credit history right away. So you can go from a 0 to 740 just like that.
So you have a 21-year-old kid getting 10 years worth of history as if they had a credit card since they were 11.
Right now, that's kind of the loophole. Yeah.
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 I just want to clarify because that's what it means, right?
Yeah.
You're leveraging someone else's credit profile.
Yeah.
And it works. Now, there is talk in the industry that they might be making some changes with that. Changing the FICO score that they use will be more of a trending credit score. Rather than a snapshot in time, it's more of a trend over a period of time. But as for right now, until that change goes into effect, why not use any advantage that you can? So
the downfall on that though too is if that authorized user maxes out their score or their credit line. So say they have a 10,000 limit and they've got 10,000 on their credit line at the time, it could actually hurt that borrower score too. So we just had a client that they put everything on a Christmas credit card and they were at an authorized user and they had a $7,500 balance now, and now that there's a $250 payment to their DTI. So you got to make sure if you're doing the authorized user that it's a good standing account, and then that they don't have a big balance that's going to affect the buyer.
So explain that in more detail for the listeners. Why does your credit card balance? I mean, why does it matter if someone's giving you a $10,000 limit, but you're telling me having a $10,000 balance is bad?
Yeah, so that's another kind of myth in the credit world is, hey, if I go get a credit card, say for $10,000, let's say $1,000 to keep the number small. If I get a limit of $1,000, if I go put $1,000 on it, it's going to report and hey, I'm going to build credit, right? The way the banks look at it though is a little bit different. If you think of it as like your friends borrowing you money. So if they give you $1,000 and then you go spend all $1,000 right away, there's no more money that your friend gave you. And so the way the banks like to see what happens is, say in that friend example, they give you $1,000, but you only go and spend $100. So you're being a good steward of that money, say that credit line, and then you pay the $100 off right away. So the credit bureau, that's how they look at that, and they give you a better boost in your score if you don't go max it out and use all your friend's money right away. And so kind of what I've seen in my experience is if you keep it up under about 20 to 30% of the total balance to limit. So in that $1,000 example, if you don't carry more than like $200 or $300 a month on the card at a time, you're going to slowly get 5 or 10 points boosted at each and every month. Whereas on the flip side, if you carry 30%, 40, 50, or max out the card, you're actually going to get dinged each and every month on that.
Okay, I like that. So that's the thing with a credit card is it's a line of credit that you can borrow, you can pay down, you can borrow, you can pay down. It requires a little bit more of a management skill compared to an auto loan that is just a fixed term with the same amount, payment every month. Mm-hmm. So I think that's a key that requires more management and showing a little bit more discipline and self-control from the actual borrower. Tell me about some other myths. I know you meet with clients that come in and have this idea of what their credit scores are or what helps and hurts. What are some common myths that you deal with your consumers that you're constantly having to clarify?
Yeah, the one myth is I don't want my credit score pulled because it's going to hurt me. Typically what we've seen is if you do have a hard mortgage inquiry, you're not going to see a big drop. And if you do, it's going to recover pretty quickly because the bureaus do allow you to have inquiries, and to extend credit. Usually within 60 to 90 days, I think is kind of the last thing I had heard from the credit bureaus, that if you do have a mortgage inquiry, you can shop around and it's, another additional inquiry is not going to hurt their score. Where you see the big drop in the credit score is if you get a mortgage inquiry, you get an auto loan inquiry, you get a credit card inquiry, you get different types of inquiries. That's going to hurt the score, and then it looks to the credit bureaus like you're trying to take on a lot of debt, and so they kind of slowly hit you with that.
Why are you trying to get your hands on so much fast?
Right? Yeah. Why you taking all these loans? Yeah. So that's where we kind of see that. Another kind of funny myth is I was looking at cars this weekend or whatever, like a month ago, and the bureau, the car, I don't want to put the car dealerships under fire right now, but I don't know if you see it, but it's we're only going to do one inquiry. It's a soft inquiry, and then you look on the credit and there's 15 credit pulls, hard inquiries. So I've seen that drop client scores quite a bit, but that's one, I don't want to say credit myth, but something that happens quite frequently of, oh yeah, hey, we were looking at cars and they said they were only going to pull it once and there's 20 inquiries now.
Right.
Do you see that on your end?
Not as often as I used to, but we do see it. The good news is that people aren't buying cars very often. So if I'm pulling a credit report that's within 120 days of when that credit inquiry took place is when they will all appear. So when you get a credit report, what are you looking for? What are the areas or sections that as a loan officer you're analyzing? 'Cause, I mean, a credit report is 20 pages. I mean, they range,
easy,
but they're pretty lengthy. What are you looking for in that pile of paperwork?
Yeah, so my kind of flow, I guess we could go through is when you're looking at a mortgage credit report, the first thing to kind of know, I guess, and just a good kind of insight for home buyers or any just consumer is we work off in the mortgage world is a FICO scoring model. So it's an older scoring model, and it puts a lot more impact and weight on your history. So it goes back a lot of times 11 years, 7 to 11 years. So if you're comparing it to like a Credit Karma, the score's going to be a little bit lower most of the times on a FICO scoring model. But first thing I'm looking at usually is the score. So there's 3 credit bureaus, Equifax, Experian, and TransUnion. I'm looking at those 3. It's usually kind of towards the front of the report. We go off of the middle of the 3 scores in the mortgage world. That's how we determine kind of interest rates, mortgage insurance. If there's 2 or 3 borrowers, we actually go off the lower of the 2. So if you've got a buddy or a family member and they've got a lower score, you're gonna get, it goes off that lower score. From there, then it's open accounts is what I'm looking at. So when that's pulling up, that's if you have like a car loan or a mortgage, credit cards. It shows all those active accounts. I'm usually looking, I don't really care about the balance. I don't know how you look at it, but for me, it's the monthly payment because we're trying to calculate debt to income ratio most of the times. So I'm looking at that monthly payment on that account or each of those accounts. And then from there, from the active accounts, then there's a section that's called derogatory accounts. So that's once you get through all the active accounts. Derogatory accounts are things like a collection account, judgments, bankruptcies, foreclosure. Those will all show on there if it's within that 7 to 11 year time frame. And then from there, kind of my like dirty little secret is I'll actually go and look. There's a section called other inquiries. I don't know if you do this, but you can see who's pulled credit within the last usually 90 to 120 days. So in that section, you can see if they've inquired to get like a new credit card or another mortgage loan even. So you can see if another mortgage company's pulled their credit. And that's, for me, it's just kind of shows me like, hey, are they taking out a lot of debt? Are they not? Like what are their like behaviors and credit habits? And then from there, the rest of the pages are kind of just more standard. But from there, I'm just trying to get a full overview of, okay, what is their score? What kind of debt do they carry? What loans do they have? And then how do I factor that into then a debt to income ratio? Yeah.
Any loan officers that might be listening out there, if you're not looking at those credit reports and looking at the inquiry section, that is a great habit to get into to avoid some future heartburn. To me, you can see if they're shopping for a mortgage and have had other inquiries with other lenders, right, other mortgage loan officers. But if it looks like there's an inquiry that could have a credit report, or credit card or automobile loan, that might come up later and turn in that it might show up on a credit report or at the very end as an additional debt that could push you over on your debt to income ratios. So it's key to ask up front at that initial consultation, did these inquiries translate into an actual loan? And if they are, what were the payments, so we can calculate things accurately? I don't know if you've ever had something come back and bite you. Mm-hmm. You hear the horror stories out there, but that little extra due diligence can save some heartburn.
Yeah, so like if, back to our point of, hey, there's 15 car loan inquiries, did they actually get a car loan, and is there a new debt that we have to factor in? Because a lot of times if someone does go get a new car loan or a new loan, new credit card, sometimes that won't even show on the actual credit report for 60 to 90 days. So there is kind of like this gray area window of, they might actually, I don't want to say like be hiding debt, but there could be debt that's not fully public yet.
Being accounted for. I had a strange situation, a loan that we closed just a month ago. I did a pre-approval. The numbers were relatively tight. I feel like with the current environment that we're in, debt to income ratios are higher than normal, than what we were seeing in the years previous to. And there was not an automobile on this credit report. It was new construction. Fast forward 4 or 5 months later, when we go to pull an updated credit report, and there's an auto loan showing up on that credit report. Well, you would have thought that the consumer got the loan in that 4-month window of time after we did the pre-approval, but before I pulled the second credit report. But when you look in the body of the credit report, it shows that it was opened a year ago. So for whatever reason, it didn't show up on the report that I pulled. I still had to deal with it, and the borrower didn't do anything wrong. But now we have, $400 or $500 debt that we have to manage when things were already tight. So it required a little bit of MacGyvering to get that deal done. But ask the questions, right? Is there any debt that's missing here? Any monthly payments that you're making that we're not accounting for? B, looking at the recent inquiries that can kind of tip a loan officer to asking those types of questions. But sometimes you have no control over it, and you got to deal with it, as it comes.
So what are some options then at that point? As if there is a car loan and now maybe the debt to income ratio is too high.
Yeah.
What are some hacks or solutions?
There are 2 ways to increase someone's buying power. Either add income or eliminate debt. There's no other way. Now, can you add income by adding a cosigner? Can you add income because there was an income source that you weren't documenting before, now you're choosing to document it? But you have to go back to the drawing board and say, hey, is there any way that we can pay off any existing loans on the credit report that would be equal to what the auto loan is? And sometimes I'll take situations like that maybe some fairly low credit card balances have fairly high minimum payments. And sometimes that would be the cost-effective route rather than paying off the auto loan. In this case, we actually changed loan programs. And the other loan program allowed us to have a higher debt to income. We're able to get the deal done. Payment was higher for the consumer. The other loan program had a lower monthly payment, which would have been ideal, but we had to pivot. We had to adjust. So, yeah. Credit can be an interesting gig. So what else? What are other things? Well, I want to go back to what you were saying. I'm recapping in my mind. You look at the credit scores, because what does the credit score represent? What does that mean to you? Or banks?
Yeah, your likelihood of paying back the loan, I think, or their likelihood of getting their money back. Kind of in like a
Their way of assigning it a grade, right? They're grading your ability to pay based off of your track record, how you have performed. So it's just a snapshot that says, hey, that's a really high credit score. This person's pretty good at paying their bills.
Right. Yeah.
And then you look into the trade lines that are open and active, loans that they currently have that they're making payment on, and then derogatory. How much does that derogatory section impact a pre-approval and credit score? How much does someone worry about that?
I mean, it can affect you totally being able to buy a house. Some things aren't as impactful as you would think, but yeah, it's definitely going to come into play. And we can kind of get into a few of those things.
Yeah, give me an example of something that someone might not need to lose sleep over, and maybe something that they would.
Yeah, so a couple. So collections, first off. Most of the times we don't necessarily care about collections. I use that lightly. Most of the times if it's under like $2,000 total with the collection, we don't really care. With the collection, it's not so much that it's a collection, but it's how does that affect your overall score and why is there a collection. If you didn't pay, a few years ago, medical collections are totally pretty much disregarded now. So if you didn't pay a $50 medical bill or something that's on there, most of the times that's not going to affect you from being able to buy a home, but it will affect your score, which could then affect like which loan program, interest rates, things like that.
Why would the industry kick out medical? Why do they not care about that?
I don't know the real reason, but for me personally, it was just, some of these medical collection companies just have like crazy overreach, and they could just throw on a collection to just about anybody. I mean, it's like it gets really common to see a medical collection, and a lot of times you don't get notified. And I mean, I've had a medical collection. It's like $50. Like, what the heck? And now my score is 50 points lower.
Pay your copay, bro.
Well, sometimes they don't send it to you. Like
I know.
You get the stories from borrowers like, I never got it, and then legitimately sometimes they don't get it. And then it's like a doctor walks in and they prescribe you an Advil, and that's $100. And you never check that off.
And I don't know where I picked this up. I don't know if someone, if I heard it from someone, if I read it somewhere, but the thought process with the medical was you generally don't sign up like a contract to have a medical emergency. Medical emergency is like you go to the ER and the ER bill turns into a collection. You didn't sign up to get into a car wreck and be rushed to, right? But you did sign up for that gym membership that you chose to stop paying.
True.
You made a conscious decision to not make that payment obligation.
Interesting.
You stopped paying on the cell phone contract that you signed the bottom line on. And so I think the industry looks at that a little differently on, what did you actually have a contract that you agreed on and what did you not?
Interesting. Yeah, I haven't heard that before.
So
that makes sense though.
Yeah, at least logical. And I don't know if someone said that to me or where I picked that up, but I've carried that over to quite a few consumers because the most common collection that I see on credit reports with my clients are medical.
Yeah, that's probably the most common. And then I get a lot of, unpaid phone bills. So that'll factor in, to the score.
Okay, so let's say I'm the client. You pull my credit report. I've got 3 medical collections, and my response is, oh my gosh, Sean, I'm so embarrassed.
Yeah.
I take this super serious, paying my bills. I'm going to go home and pay those right now.
Yeah, I would if we're role playing, I would say, hey, let's wait to maybe do that, because it might actually not improve your score or have a positive impact. And in fact, it might even actually hurt your score.
Why? Why would it hurt your score?
So the algorithm that the credit bureaus use to give you that FICO scoring model, each account is weighted different based on the age of the account, the balance of the account, when it was reported last. There's a bunch of different factors that go into how that plays into your score. And so sometimes if something's removed or changed, that overall balance can be adjusted and can actually lean against your favor. And so usually when we pull a credit score, that's going to be good for about 90 to 120 days. And so we usually don't want to mess with it, especially if we're right on like a verge of like a credit tier that might actually help you qualify for a better rate or something like that. And so a lot of times we don't want to tweak it too much unless we can do what's called like a loan or a credit rescore and forecast it, and we can see it will actually help that person. The same goes for like credit cards too. I'm sure you've had the client that's like, let's wait to pull my credit, or I have a lot of credit card debt, and so they don't want their credit pulled. But if say they paid their credit off tomorrow or all their credit cards, they probably won't even see that benefit for 30, 60, 90 days possibly. And so a lot of times it's like, hey, let's just see where it's at, and then we can actually help you. If you're going to pay it off, we might actually be able to get your score and do it internally and do it quicker. Yeah.
So any consumers that are listening that might be getting a loan, real estate agents that might not be familiar with this as much, what Sean is referring to is lenders are going to pull their credit reports through a specific company, and that company will usually offer some kind of software system that analyzes the formula, the algorithm of pulling credit, and this software will be able to tell you what will give you the biggest bang for your buck to pay down. And sometimes it's not, I say pay down because it doesn't always say pay it off. It's usually saying pay it down to a specific dollar amount to maximize a kind of a rapid increase in credit score. So huge tool for lenders to use. Often maybe underutilized by loan officers, but that will help those clients that are a little bit reluctant and they're kind of sitting on the fence trying to get, quote unquote, their ducks in order. But sometimes meeting with the lender will help them get those ducks in order more efficiently, maximizing those scores in a shorter period of time.
Yeah. So. Yeah, because if a client does wait, say they are waiting to pay some debt off and they, it takes 90 days and then they're like, hey, let's pull it. First off, you don't know when those companies are reporting. So it's like almost impossible to time it. And then who knows what other accounts are going to report. And so it's almost like this, you just never know where it's going to pull in. And so if it is on the horizon or if it's in your plan to buy within, 6 months or 12 months, I would just recommend, hey, at least see where you're at. And then you can run, have your loan officer run that rescore analysis and say, hey, yeah, maybe I can pick up 10, 20, 30, 40, 50 points or more within that time frame and help me qualify for that, that better loan program or get that better interest rate. But you just don't know until you check it. And doing it yourself, you might actually hurt yourself.
Yeah.
Pay down the wrong things. Sometimes you don't need to pay off your credit cards. That money's probably better used maybe towards the down payment.
Yeah.
So there's a whole lot of variables that go into it. And it's meeting with an expert loan officer that can dive deep into credit and help coach you through, hey, where is your money best placed, or how do we best assess your credit to help you qualify for the best loan program?
Analogy that I use quite frequently is you got people who are wanting to build their credit but do it blind, right? They're waiting until they can pay some things down, but they don't know what the outcome is going to be, right? They're just going blind. Where if someone can sit down with the loan officer and have their credit pulled, you can get real strategic. You can get really granular with them, and it's kind of like, if you're gonna start a weight loss program, you got to step on the scale.
Mm-hmm.
Face the music on where you're at, and then you can game plan around it from there.
Yeah.
So pulling that credit report is that initial step of stepping on the scale.
Yeah. Sometimes it's better to just embrace the reality and see where it's at, and then go from there.
Yeah. But then you're doing it eyes wide open because you know what you're dealing with. You know the balances, and now you have the software at the disposal to help you identify which accounts are weighted heavier.
Yeah, and there is too, I think a lot of times, maybe sometimes some emotion and maybe some guilt, or, it's just like, hey, they're going to judge me or something. And, at least from my perspective, we see so many numbers and so many different credit reports. It's, like we're not even really looking at it necessarily like, oh, you have a lot of credit cards, It's really just, hey, you're wanting to buy a house. What are your goals and how do we get you there? And, it's really like a non-judgmental, process, at least for me.
Yeah.
We don't care if you went to Sportsman's Warehouse and got a huge $5,000. We just won't say that when the wife's around.
Well, let's
hey,
talk
where's
about
that credit card?
I shouldn't say have you ever, because I believe you have. How often do you review a credit report with maybe a husband and wife, or a spouse, significant other, and things are showing up on that credit report that the other one didn't know about?
I wouldn't say it's like it's happened before for sure. Yeah.
Got any good stories?
I mean, just long, awkward silences, like, you could hear a pin drop. You want me to leave, Yeah. You have any good stories?
Oh, I have one that will. My dad told me earlier in my career that I should start having a work journal and writing down certain events, certain, moments that if you're in a career for an extended period of time, you kind of forget some of those, but this is one that will stick with me regardless. But I have a husband and wife that sit down and meet with me, and they actually did an online application, but they came down and sat down. I've had too many times where something's been missing on a credit report, something that should be there, or something that's there that doesn't belong there, that's already been paid off. So I pull a credit report and want to go over every line item and say, is this accurate? What am I missing? Is this balance maybe significantly lower than what it was 30, 60 days ago when it reported? And when I turned my monitor for the clients to meet, the wife started getting a little bit uncomfortable and kind of trying, yeah, that looks right, trying to move us forward. The husband wasn't in a hurry and wanted to go through that. I don't know if he wanted to, but he was comfortable enough to go through the line items. Well, we start going through the line items, and there was a credit card through Victoria's Secret. And it did not have a small balance. It was fairly large. Now, part of the backstory that I didn't know about until further into the conversation, this couple had historically had trouble with credit cards, and they agreed to cut up credit cards and not use them. And she had gone and opened up this credit card without her husband knowing. It was awkward enough. I could feel the tension rising enough that I excused myself, let them have a few minutes together. The balance was large enough, and apparently this gentleman was not seeing any of the product that was being purchased at Victoria's Secret.
Okay.
So that wasn't the only, trouble in paradise. Needless to say, they did not get a mortgage. They ended up getting divorced, all because of a Victoria's Secret credit card.
Yeah, that was my one question, is if maybe the husband's still getting a benefit from it. And so he's like, hey, it's a win-win, didn't know about it, but sounds like you didn't, huh?
It was just one of those awkward moments. And I think as a loan officer, you got to learn how to roll with those awkward moments. There's sometimes where the conversation's like, I'm not a therapist, right? I'm not your ecclesiastical leader. I'm going to step out and let you guys, talk this through and decide what you want to do moving forward. But
so on that note, though, so say you have a husband and wife, and say they're, one has more debt than the other. Are there some strategies you can use to help them qualify?
Oh, absolutely. We talked about at the very beginning of the podcast, there's three main categories that we look at: credit, income, and assets. I like using loans, case studies as examples. But I actually got referred a loan from another lender that got declined. And they got declined because of debt to income. And the loan officer was quite frustrated about it, felt like it was a doable deal. He sent it over to me. I looked at it, and the wife was on the loan. She had decent credit, right? But she had no income. And she had $40,000 worth of student loans. So to me, it wasn't rocket science. It just took someone new looking at it from a different perspective. Because she wasn't contributing any income, all we had to do is take her off of the loan, which also took the debt off of the loan. And all of a sudden, the numbers lined up perfectly with just the husband.
You can do that in a non-borrowing or a non-spousal state. What's that term? We don't have to factor in the spouse's debt.
Yeah, state of Utah.
Yeah,
right.
Yeah.
So, and so that was a very easy one. We just dropped her off the loan application, took her off of the purchase contract, and were able to get the deal done.
And in that situation, you'll just want to add the spouse or significant other, the partner, to title, right?
Yeah, it's usually not required but recommended.
Mm-hmm.
So it's kind of a puzzle piece game for your loan officer. You're looking at the debt, you're looking at the income. How can we move these puzzle pieces around to sometimes increase the purchase price to the target, the range that they want to be in, and second, which to me is even more important, is maximize the terms. If we have one borrower on the loan that has a lower credit score and we're having to offer a higher rate because of the lower credit score, if there's enough income with just the one borrower, you got to look at taking that other one off if we can improve the terms.
Yeah.
So I think that's our job and responsibility as a loan officer, is try to advocate for the borrower to get the best terms possible.
100%. Yeah, and on that same note too, you could have possibly a spouse, say they don't have any income, but that maybe they don't have any debt, but they've got a really good credit score, and the main borrower, they have mortgage insurance, they don't have 20% down. Sometimes you can hack that, and with 2 credit scores, you can get a better price mortgage insurance.
Yeah.
So sometimes it's, well, hey, what is, you said your wife doesn't want to be on the loan or whatever, but maybe we can add her on and help improve their overall situation that way.
Yeah. Yep, and that's getting pretty granular. That's
Yeah.
getting a little deeper. I want to go back a little bit more to the credit score 101. It feels like what comes first, the chicken or the egg? If I pull a credit report for somebody and it's coming back not applicable, and then they turn around and apply for 3 different, mainstream credit cards for what they, credit card advertisements that you're seeing, while you're watching TV, and they all come back and decline them because they don't have any credit scores. Well, how do you get a credit score if you don't get a credit card? So how do you fix that?
Yeah, good question. So the authorized user hack, sometimes that's an option because a lot of times it doesn't pull credit, or there's not a credit qualifying process for that person. The other one, especially if you have lower credit, is a secured credit card. So the secured credit card is like with that example we talked about with like your friend giving you money. Instead of the bank giving you money for credit, you put up your own money. So a lot of times it's $500. The bank will say, hey, let's just pull money from your checking or savings account. We'll put $500 in there. And then you prove to us that you can establish credit and be a good steward of that $500 or whatever the credit line is. And then from there, you just kind of draw off of it, almost like a debit account, to relate to, someone if they haven't had a credit card. And then over time, that'll report, and then you can kind of like graduate and then get, a full normal credit card from there.
So what you're describing to me, if I'm summarizing it, is it's a prepaid credit card with your own money.
Exactly. Yep.
You put $500 up front, then they give you a $500 limit. But my understanding is these banks and credit unions that offer that product, they freeze that account, so you can't just go out and withdraw the money, right? They hold it as that security or collateral until you can show that you can borrow and pay back, and then eventually we'll release that collateral.
Yeah.
Now,
because if you don't have a score, the bank looks at you as high risk, and so instead of the bank saying, "Hey, take my money," they say, "Hey, put up your own money." Yeah.
So how long does it take from a bank or credit union offering a secured credit card, which really lowers the risk to them, before they will convert that to a normal traditional credit card?
Yeah, I actually don't know the answer to that. I would guess 6 to 12 months, maybe. I mean, do you?
I don't know the fast or strong answer too. That's kind of why I was floating it to you. I just know that the credit report won't reflect their formula doesn't give you the same benefit on a secured card versus a traditional credit card. So it's key that you want to be following up with your bank or credit union on a regular basis, asking for them to convert that to a traditional card, because that will end up helping your scores increase faster than the secured card. But the secured credit card is that stepping stone to get you to the traditional, and continuing those steps. I would say that 3 to 4 months before you even have a track record of making multiple payments. Because if you get the card today, right, you got 30 days worth of charges before you get your first statement, and then that payment is still kicked out for 2 or 3 weeks before that first payment is due. So you're at least 3 months or 4 before you have a track record of making a couple payments. So my guess is it's got to be probably closer to 6 months would be my guess.
Yeah, that's what I would think too, just to show the established credit and boost it up.
Why doesn't the average consumer know about a secured credit card? Because every single time I talk about it with a consumer, they look at me with this like blank look, like they've never heard it before. They're shocked.
Yeah, I that's a good question. I don't know. It's not like advertised.
Yeah, banks and credit unions don't advertise it. It's like you have to ask for it before they present it as an option.
And maybe because it is high risk, and they're probably going to make more money if you default on the 27%.
But that's the part that I get. You say it's high risk because you don't have a credit card, but if you're fronting the money, there's like no risk, right? Because you're fronting the security of it, of the prepaid credit card. I've just always thought that was kind of interesting, that it's a tool out there that people use to help build credit, but you have to have the knowledge that it's there and ask for it. I just feel like sometimes I'm disappointed in kids coming out of high school and even out of college with their financial literacy, right? I just don't feel like there's a baseline and foundation that maybe they should have, and two, I don't think financial institutions make it very easy for them either. They want to work with their less risky, higher end clients rather than working with the lower risk, less income earning borrowers.
Sure. Yeah. Yeah, and it's just financial literacy isn't really taught,
At least not. It's a lot better now than it was when I was in high school. Knowing there is some curriculum now where I didn't feel like there was anything when I was in high school. So it's better, but I still don't think people are some of those initial conversations I have with people, it feels like the knowledge they've gained is more through their parents than anywhere else.
Yeah. And a lot of times, good, bad, or whatever, sometimes it may not actually help them with the home buying process too, Do you want to talk a little bit about student loans?
Student loans.
Yeah.
What about them?
How do you look at them? How do mortgage companies look at them? Do they help you? Do they hurt you?
Oh, here's what's interesting. A lot of people get one statement for their student loans, and so they assume that they have one loan. They might only make one payment, but often when you and I pull a credit report, we might get 7, 8, 9, 10, or even more, and that's because each loan that's issued each semester that a student borrows money shows up as a new trade line. Now, at the end of, say they graduate and they start going into a payment, it's very common for people to consolidate those, all into one. But I actually have had clients that have missed one payment. In their mind, it's one payment, but they had 10 different trade lines because of 10 different semesters, and it actually hit them with 10 late payments because it reported late on every single one of those. So it's not saying that they're necessarily good. It's not saying that they're necessarily bad. It's understanding the way the bank looks at them and how to calculate them so that you can plan accordingly. So if someone is in deferment or often showing a zero payment on a credit report, a loan officer is going to calculate a monthly payment for that, because if you're at a deferred or a zero, it means every year they're going to establish what that new payment is going to be, and we're committing to a 30-year mortgage. So we know a payment's going to generate eventually during that 30-year window. We just don't know when. So we need to plan accordingly for that. Each loan program calculates that differently. Some require you to take 0.5% of the balance, and you can plug that in as a monthly payment. Others require a 1% of the balance. So student loans are getting crazy, man. I don't know what the average credit report for you is showing, but I mean, it used to be someone that had $10,000, $15,000 of student loan debt. Now I'm seeing 20, 30, 40, 50. And if you're looking at lawyers and doctors, you've got 6 figures worth of student loans on credit reports. So you start putting those numbers in, that's a big chunk that's going towards your debt to income. So is that I want to make sure I'm covering, the direction you are going with that.
Yeah, because I get some clients too where they maybe get a little embarrassed of like, hey, I have a lot of student loans. And a lot of times we don't necessarily care what the balance is, right? It's that monthly payment. And so really digging deep as to, hey, what is the monthly payment? Do you have a monthly payment? Because a lot of times if you do an income-based repayment, if you're within certain income tiers, you actually have a zero payment, which is awesome. And we can, with certain loan programs, use that zero payment to help you qualify, And so, I would just say, like, if you do have a lot of student loan debt or like hesitant to go apply, it's, there are some workarounds and some different ways to look at it.
Yeah. I think that knowing the loan type that you're likely going to fit into and how the banks, approach that calculation is critical. Like you say, it might not hurt you as much as you think it's going to, or it might actually have a big impact. You just got to get into those conversations with your lender.
Yeah. Yeah. And there is kind of not to get like too deep into it, but for doctors, you mentioned, physicians, if they do have a lot of student loan debt, there are some kind of unique loan programs that actually don't factor in that payment, because they know, hey, they're going to be in a pretty high income earning career, and can pay that back pretty quick. And so there's kind of some unique hacks if you are, in law school or medical school and do have some higher student loan debt. That's not going to inhibit you from buying.
Yeah.
So,
good advice on that. Good advice. I've always kind of thought, and maybe this is me, conspiracy theory. I've always, since the housing crash of '08, housing is what put the economy in a tailspin. I remember having a conscious thought process several years after that going, oh man, what's the next financial crisis? I cannot help but think about student loans because I feel like it's so loose. They issue out student loans as if it's candy, and it doesn't matter what degree a student is pursuing, their ability to repay that. It's very loose requirements of getting student loans and what that money can go towards. It's not just tuition and books and housing. It's sometimes supporting a lifestyle that college students aren't eating tacos on Taco Tuesday and peanut butter and jelly and top ramen anymore. I find that the lifestyle is a little bit different than it was when I went to school.
Yeah, I remember sitting down with my counselor one semester, and it was like, oh yeah, hey, here's all these, because you do put in your income, right, or your family's income to show what loans you qualify for, student loans. Sure. And it was like, oh hey, I get this one, it's 0% interest, it's like $2,000, and oh wait, there's 3 other check boxes, $5,000, $5,500, $7,000. That's a lot of money, and all you have to do is just check a box. It's like maybe I do need $5,000. I could buy a lot of books with that. But it's really easy to get into a lot of student loan debt because it is so easy. Or at least when I was in school too, it's just like, and then when you're out of school and then have to repay it, the payments come due. It's like, man.
But I guess that's the two piece I want to talk about is easy access to money by checking a box, but yet we don't have the discipline of the person actually borrowing it, only spending it for what it's meant to be spent for. Mm-hmm. So
yeah,
the lack of discipline and self-control, and I just wish there was a little bit. That is a system that I feel like needs to make some tweaks and changes, because that trajectory is kind of scary. Because student loans can really impact someone's buying power.
100%, yeah, and that it's interesting you bring that up too, because that debt is a federal debt. If you get the loan through,
what does that mean? What does it mean to have a federal debt?
So that I don't remember when the change happened, but when the government took over issuing all these student loans, these federal student loans, they now service that loan, and now you are indebted to the federal government for that that loan. And when it comes to the mortgage world, a federal debt supersedes a mortgage debt. So if you don't pay on those student loans, they can foreclose on your house. So I've had a couple clients where they didn't pay on their student loans, and they can't qualify unless they get those in an active status or get in repayment, because it is a federal debt. So it's seen as like you didn't pay your IRS taxes, and you didn't pay property taxes.
So what about the person that runs into unexpected health issues? They get overwhelmed with health bills and they go to file bankruptcy. How are the student loans treated there?
From my understanding, those they basically just hurdle the bankruptcy proceedings.
Those are with you and stuck with you for life.
And I've heard they can even follow up to your heirs too. A lot of times if you pass away, sometimes they'll try and go after the estate.
I can't speak from an educated place on that, but I wouldn't be surprised by it. And that's why I feel like if it's a debt that is like a ball and chain that's going to follow you, but yet it's really easy for us to gain access to that money, that's the problem I'm talking about. That's a concern. That is a problem that's just simmering and could turn into a boil.
Yeah. And it's if you're pursuing a career, I guess for the viewers, I'm not saying like all student loans are bad. Because and a lot of people have to get student loans. They might not have family support or anything. Like they need that to get through college. But I think it's just more recognizing, hey, what is the future impact going to be like? What's that future like debt burden going to be? That future payment when you're going into, applying for student loans or even like taking out as minimal amount as you need, because it can affect you long term.
Yeah. Totally agree. Well, I think we've covered some really good stuff on credit today. Obviously, it's one of the 3 pillars of lending that lenders focus on. Credit's something that I feel like, in summary, at least from my point, is it's like a sports team. It may take years to develop a good team, but it can get destroyed really quick. Mm-hmm. So it can take years to build a really good credit score, and it only takes a couple missed payments to really damage your score. So it's something that you need to be conscious of, working towards, and constantly maintaining.
Yeah, and late payments, they have a different effect for each account too. And so you never want to see a client have a late mortgage payment. That's going to be like the worst impact that they can have. That's going to, affect them for years and years. But if you did have a client that's maybe in a tight spot, do you have a recommendation on
what to be late on and what not to?
Yeah.
Oh my gosh. I don't know if
obviously you don't want to be late on anything, but
well, I guess I think about it putting myself in my own spot. If you miss a credit card on a credit card payment, you generally don't get kicked out of your house. But if you don't pay rent or you don't pay your mortgage, you're eventually going to lose your housing. If you don't pay your car payment, you're eventually going to lose your vehicle. So less focused on what's going to impact your score and what's not. I usually do it off of, survival. What can I live without and what can I not? And housing and transportation are right there at the top that you just don't miss. So I would guess saying probably your credit cards and even utilities are scary. You stop paying your water bill, well, they're going to turn off your water.
Yeah.
But you might get by for a month or two and pay a few late fees and to get kind of caught up on utilities. But yeah, I guess I've never thought about that or had the question posed to me, so I hopefully answered that in the right way.
Well, I just know right now with the way the economy is, a lot of people might be tight on funds, and so if they do have to miss a payment, it's inevitable, right? It's where do they turn?
I will tell you, no matter what, communicating is key. If you're going to be late on a mortgage, but you're calling your lender and you're informing them of the financial hardship, they're going to be more workable with you than if you just ghost them. It's going to be the same thing with a credit card, same thing with the utilities. The key is being responsible to communicate that hardship and not leave people in the dark. Mm-hmm. That to me is a more important piece of advice.
Sure. Yeah. And I think it's important too is there are ways to get yourself out of maybe a tight credit spot. If you maybe got into a lot of debt or you're having a hard time making your payment, a lot of times, especially if you've bought a home within the last 3 to 5 years, you have a lot of equity in that home. And so versus missing a payment and having to foreclose or selling the house, you might be able to consolidate that.
Yeah.
And might be able to take, say you have a car payment for $2,000 or a car payment for $1,000, a house payment for, a mortgage for $2,000. Say your overall debt's $5,000 or $6,000 a month with everything. You might be able to consolidate that and make it go down to like $3,000. Yeah. So,
but right now, and I know we're probably going a little bit longer than what we planned on. Right now, I see people reluctant to do that. Here's what's sad, Sean. I saw a report and it kind of made me sick to my stomach. Our spending hasn't changed much. As inflation has kicked in, the cost of food, the cost of gas, the cost of housing, all of it has gotten more expensive, but we're still spending and our habits haven't changed. We're just swiping the credit card, and that credit card that used to be paid off every month now is carrying a small balance, and then that balance grows a little bit more next month, and people are accumulating this debt. Well, this is the same group of people that I'm talking to, and they don't want to refinance their first mortgage because their first mortgage has a 3.25% interest rate on it, and they don't want to give it up. But yet, they've got this consumer debt that's mounting, and your suggestion is spot on. Yeah, consolidate it, and you can probably lower your household budget.
Mm-hmm.
But then you got to give up the 3.25% interest rate. Give me your thoughts on that.
Yeah, I mean, it's there's a handful of factors that play on that, but ideally, the consolidating debt, the strategy behind it is to free up monthly cash flow, so you have much less monthly payment that you can now afford. But then it's strategic in, hey, let's use that excess cash flow now to snowball and pay off that debt sooner. So say you can free up $1,000 or $2,000 a month in monthly cash flow on your budget. $1,000 a month in pure mortgage principal over 5, 10, 15 years, that's going to put you in a much better situation than barely squeaking by paying a 30%, high interest rate
it's
credit
just breathe
card.
the room. It's getting you off the edge of the cliff. It allows you to not, worry. I totally agree with you. And on paper, it makes sense, and we do it frequently as loan officers. But there's also a trend with our consumers, just talking about real life here. They're the ones that are going to just rack up that debt again, and we're going to see that same consumer in 2 or 3 years when they've overwhelmed themselves with more consumer debt, wanting to consolidate again. And we help those borrowers. We do it on a regular basis. But I hope you see what I'm trying to share, that I just wish people had the discipline to actually execute the piece that you're talking about, and that was to pay the extra $1,000 of principal and stay the course.
Yeah, and I bring it up just because if there is somebody that's in a tight spot, there are some things and tools and strategies you can use.
Call and talk about it, right?
Yeah. Yep.
Yeah.
Because you might not know you can use your equity to do that or consolidate, or you can get an equity loan. There's just some things that can you can use your home as leverage and as an asset to put you in a better financial situation.
Yeah, totally agree. And I know I've gotten on a tangent. My opinion on the student loan stuff, the opinion on consolidating for consumers. I guess I just get passionate, Sean, about the consumers I work with. I want to see them have financial success and work towards eliminating debt altogether and building wealth for their future legacy. And so I guess when I see trends, sometimes I got to bite my lip and have my own personal, views and opinions and biases. But I genuinely care about my clients, and I want to see that growth. I want to see those steps, taking those steps.
Yeah. Yep. And it's hard, when you do see somebody maybe get into that habit or that cycle. And I think the best thing you do is just help educate them and help them,
Yeah. Yep. You can take the horse to water, but you can't force them to drink.
Right. Yep.
So, well, Sean, I've enjoyed the conversation. I appreciate the nuggets as always. And if anyone who's listening there, please share this podcast with 3 different people that come to mind that might benefit. And other than that, that's a wrap.
Yeah, no, I think we covered a lot of great topics. If you have any questions on credit, income, assets, stay tuned. We'll have that income and assets podcast dropping in the next couple of weeks. But we're here to help with any questions, any scenarios, situations. We're the After 5 p.m. mortgage guys.